The key is that they aren't taxed at the corporate level at all. Instead, the shareholders report these items on their individual Form 1040, and the income is taxed just once at their individual tax rates. This pass-through mechanism is a foundational, built-in financial advantage that attracts many businesses to the S-corp structure, allowing them to keep more of their earnings.
That's a massive distinction, clearly. Avoiding that second layer of tax can be a huge boost to a business owner's bottom line. But this S corporation election isn't set in stone, is it? Can it just disappear unexpectedly, or is it always a conscious choice to end it?
Oh, it absolutely can disappear automatically, and understanding these triggers is crucial for protecting your S-corp status and avoiding unexpected tax consequences. There are three main ways an S election can end.
Okay, what are they?
First, it terminates immediately if the corporation no longer qualifies as a small business corporation. This means things like having more than 100 shareholders, having certain ineligible types of shareholders, or issuing more than one class of stock.
Right, the basic requirements.
Exactly. If any of those conditions are met, your S status ends right away. You then have to notify the IRS on your final Form 1120-S. The second way, and this is a major tax trap for many, especially if your S corporation used to be a C corporation or merged with one, it's related to passive income.
Passive income. Okay, how does that work?
Well, if, for 3 consecutive tax years, your S corporation has accumulated earnings and profits and derives more than 25% of its gross receipts from passive investment income, things like royalties, rents, dividends, interest, annuities,
Gotcha.
then your S election will terminate on the first day of the fourth tax year.
Wow, okay, delayed effect.
Right. What's even more painful is that for each of those 3 years, the corporation will also face an additional tax on its excess net passive income.
Ugh, an extra tax and you lose the status.
Precisely. This passive income rule is a prime example where being proactive about managing your income sources is a crucial strategy to boost your cash flow. Because avoiding this extra tax altogether by keeping your passive income below that 25% threshold is far, far better than having to pay it.
So it's not just about setting up the S corp, it's about constantly monitoring its eligibility year after year. It sounds like a real long-term planning item.
Exactly. This rule directly impacts strategic business planning, particularly for S corporations that might acquire C corporations or generate substantial investment income alongside their primary business.